Yes. Okay, great. So yeah, so this is a paper called Echo Chambers. It's joint with Tony and Joey Engelberg, who is not here, explicitly discriminated against by the organizers. Let me just give you guys some background. So I'm sure you're familiar with this, but there is just a truly extraordinary amount of trading in financial markets. Here we just plotted total value of stocks traded as a percentage of GDP in the US. And over time, it has reached pretty high levels. 200% of GDP traded per year is not unusual. And this is also true if you look at the individual stock level. Some stocks get just ridiculous amounts of trading. So, for example, in February, before the coronavirus pandemic hit, if you look at Tesla, you can see that just over the course of 3 days, its price spiked to about $800, and 156 million shares were traded, which was essentially more than Tesla's entire free float in 3 days. Yeah. So in a very basic sense, there is a lot of changing of hands of these stocks that we typically associate with people having different views. Yeah, like why are they trading? Because they think that it's either too expensive or too cheap, and they want to take advantage of it. Okay, so this kind of sets up this long-standing puzzle, which is that we have such high volume of trading that it's hard to explain it with classical rational expectations models. So I'm just going to set my timer. I just realized I forgot to put my timer on. And the other thing I forgot to mention was this is essentially the first time we present this paper. We presented it at 2 brown bags, but it's really a work in progress. So sort of please feel free to point out any major failings, or it's entirely possible we missed something obvious. So here is we would really appreciate if you tell us now rather than at a higher stakes later setting. Anyway, back to the paper. So the trading puzzle. We've got this very high volume. It's hard to explain with classical models. They have agents with private information, but the famous no trade theorem says you need additional ingredients for trading to occur. Traditional responses would be like noise trading, liquidity shocks, portfolio rebalancing. But does that get you to the volume of trading that we've seen so far? It doesn't, yeah. And so the most popular explanation is a disagreement explanation. For example, the Harrison-Raviv paper. But this again begs the question: what keeps people in disagreement? The disagreement that's driving this trading needs to be sustained. And we see, there's a famous result, Candle and Pearson 95, showing that there is the most volume around earnings announcements, when you would expect disagreement to be falling. Yeah, the news comes out. Everyone, updates their from their prior to their posterior. There should be less disagreement, and yet trading keeps happening. So, we have potential explanations. Differential interpretation of the same information is, different models of the world. So you're feeding the same information in, and it's the output is different, or different information, like in the vein of the Hong and Stein gradual information diffusion model. What we're going to be doing in this paper is in the vein of different information, and it's a very specific form of different information, and we're going to be calling it echo chambers. Okay, so let me give you the kind of very stylized idea of an echo chamber. Imagine you have Republicans and Democrats, red and blue people in the world, and they tend to cluster. Where do they get their information? Well, you'll find that Republicans disproportionately watch Fox News, I've heard, and Democrats disproportionately watch MSNBC, I've heard. And so you'll find them, both of them getting information, but systematically selecting into different sources. And the sources, very importantly, are the ones that are going to align with people's priors. So I'm a Republican, I watch Fox News because I think they're likely to agree with me. I'm a Democrat, I watch MSNBC because I think they're likely to agree. This is the essence of this echo chamber idea. And a disagreement model thinks about this thinks about it in a different way. Thinks about that everyone has access to the same public information. Yeah, so they're all mixed together. And what we're going to do is we're going to look at a very specific instantiation of an echo chamber. We're going to do echo chambers around sentiment. So what we're going to do is we're going to say, do people whose priors are bullish about a specific stock select into bullish sources of information about that specific stock? And do people who are bearish about a stock select into a specific source of information that is likely to be bearish? So what we're looking at is echo chambers in sentiment. Of course, there could be echo chambers in along other dimensions, trading styles. We may be thinking maybe technical analysts versus value investors. There's a variety of different things. But what we're thinking about is this cross-sectional difference in where people are getting their information, and that this cross-sectional difference is associated with people's priors. People are choosing their source of information based on their priors. Okay, that's the big picture idea. And this actually is an old idea. It's called selective exposure theory. Okay, and according to selective exposure theory, it's basically this idea: you're choosing your information sources based on priors. And it's a very old idea. Communication science has been looking at this, from the 50s or earlier. There is evidence about this kind of behavior in a variety of settings in politics, in psychology, and in communications. Republicans, Democrats, smokers, non-smokers, Christians, non-Christians. And what we're going to do is look at it in financial markets. And here, the right thing to think about is, well, what's the null? Yeah. We know that this happens to some extent in political settings. Would it be then surprising to see it in financial markets? And for us, it seems that the right null is that it actually would be surprising. Yeah. And why would it be surprising? It's because in markets, people have strong financial incentives to form correct beliefs. Yeah. You want to consume all value relevant information. If you are just consuming, in particular, in fact, the information that conflicts with your priors might even be more valuable to you. But at the very least, you want to be exposed to the whole range of information. And this has no analog in the political setting, in the Christian, non-Christian setting. Yeah, there's no immediate feedback as to, an incentive as to, whether you'll be correct or not. Although, now that I say it, in the religious setting, there is an incentive. If you're wrong, presumably your afterlife will be different than if you're correct. So there is an incentive there, but it's at least very much delayed. So what are we going to do? Yeah, we're going to look at stock tweets, which is a kind of Twitter for stocks. And what we do is we look at the whole universe of about 300,000 users, and these contribute about 10 million self-labeled posts that are either bearish or bullish about a specific stock. And then what we do is we see whether these self-labeled bulls and bears choose to follow like-minded users and examine each user's newsfeed. Because the nice thing about Twitter and stock tweets, which is based on the same model, is that you create your own news source by choosing who to follow. You create your own newsfeed. And so it's a great setting for examining the endogenous choice of where you're getting your news from. Of course, people can also watch MSNBC and Fox News and so on, but at the very least, it gives us a window into people's endogenous choices about news. And after doing this, we're going to examine whether the echo chamber behavior that we find is related to trading volume. So this is kind of the plan. And there are a lot of different aspects to this, so I might have to go relatively quickly to make sure that we get to the trading volume result at the end. But what do we find? We find strong echo chamber effects, and I'll obviously tell you what we mean. For example, self-described bulls are 5 times more likely to follow a user with a bullish view of the same stock than self-described bears. And we find a very similar result with the general news feed and with the likes. So self-declared bull or bear sees many more bullish or bearish posts and likes many more bullish or bearish posts. So it isn't something that they're not paying attention to. And the results are present for professional investors. They're stronger for novices, but still present and large for professional investors. So it isn't just, people's like fathers-in-laws and mothers-in-laws who are total amateurs who are making this mistake. It's definitely there for the professionals as well. And it's stronger on big news days. And finally, we find that we see a lot of there's a strong association between echo chamber behavior and more trading volume. So this is the outline. Now let me go into the details. Okay, so let me give you an example. On November 14th, 2018, there were 2 users posting about Tesla. User number 1, his or her username is Evie is the future, which gives us kind of a very indirect hint as to his or her view. And they post that, you know, this guy posts oil giant BP gets its first Tesla power pack project, says it could lead to more. And then there's another user who is much less optimistic about Tesla. This is a Tesla bear, this is a Tesla bull. He says, you know, there are lots of great companies with strong management teams, profits and cash flows that are on sale. Why would anyone buy into this Tesla fraud? Okay, so now let's look at Evie's news feed subsequent to Evie's post. Yeah, the next day. Basically, if we look at his news feed or her news feed, 45 bullish and 0 bearish posts. Yeah, you know, Risha Singh says Tesla's about to rip. He also says, you know, Musk has acquired trucking capacity to ensure delivery of Model 3s by December 31st. Tesla Long is taunting Tesla bears, saying, you know, you guys are going to lose. CNBC bears are idiotic. Angry Panda says, you know, Tesla's going to be glorious tomorrow. Dexter Wilson, you know, provides a resource for bulls, you know, says shorts have no clue. So a very consistent worldview comes out of, you know, Evie is the future, says something on November 14th, and November 15th, the people he has chosen to follow say things that entirely align with his pride. Yeah, this is just giving you, this isn't the echo chamber behavior directly. What I'm showing you is just kind of the setting of 2 pretty extreme users. Now let's look at Dr. Burry. Dr. Burry, his next day feed is 0 bullish and 12 bearish. Yeah, and so, you know, this user says, well, be cautious, Tesla guys. You know, Tesla pray for the Nasdaq tomorrow. Nvidia's down 14%. You know, Tesla, I'm not sure how you're going to get this to 360. You know, you need a divine intervention, or, you know, from Elon Musk. You know, on and on. Very negative posts. Okay, so given that in anecdotal example, let me give you some facts about StockTwits and their users. So first of all, it's just a large social network, and they call themselves the largest community for investors and traders. Our sample is 2013 to 2019, and what we do is we keep symbol IDs with at least 2,000 messages. So it's about 1,000 symbol IDs, mostly stocks, but there are also things like Bitcoin, you know, certain funds, currency pairs. It's about like 900 stocks, 900 something stocks. We keep only messages with a single symbol because it's tricky if there are 2 symbols to assign the sentiment, the bear stamp or the bull stamp, to one of the 2. So we just keep messages that refer only to one symbol. And we remove robot users. These are people who are posting thousands of times in a single day, which would imply, you know, very, very high speed typing. So we have about 300,000 users with about 25 million sentiment stamp messages, all of which are about a specific single symbol. And then finally, we roll everything up to the user symbol day level to get about 10 million observations. Okay. Now, what does StockTwits look like? Well, when you want to post, this is what you see. You have 140 characters, and you can write what you like, and you can choose to label it bearish or bullish. Label a post bearish or bullish. So, for example, you know, here's a user called Todd Sullivan. You know, here you can see he's talking about, I keep forgetting what this is. It's like Texas Pacific Land Trust or something. And he posts, he's bullish about it. He writes his 140 characters about it. And we have this information you know, this is self-described information from Todd Sullivan. So, you know, he says he's a professional investor in these categories. He has 177 people that he follows. He's got 100,000 followers, so he's one of the big fish in this. And, you know, he posts his own website, and he writes a lot outside of StockTwits. So first question, let's look at echo chambers. Do we see it in the data? So a preliminary to this is, do we think about, just one more thing about StockTwits. So Tony and Marina Niesner have a paper in the JF using stock twits already, you know, for examining kind of a disagreement, model disagreement, and approach disagreement. So we are not the first people to use stock twits, and there are a couple of other papers as well. Okay, so do we see echo chambers in the data? Well, first question is, when someone says they're that they are bullish about a stock, is this persistent? Yeah. Do they just change their mind? Do they chop and change every 3 minutes? No. Yeah. So basically, people, when they say they're bullish at time zero, they stay bullish for about 50 days at least. You know, and this is relative to the unconditional probability of being bullish. About 80% of sentiment stamp messages are bullish. So there's a very high persistence for bulls. And then when we look for bears, again, it's a very high persistence. It goes down more, but the unconditional probability is about 20%. Yeah, so people keep hold of their positions for a long time. And so the first result is we can see who people choose to follow. And so we focus on users declaring themselves either bullish or bearish on a stock, call that the event, and then we plot the accumulated new bear, bull bear follows in event time. And you know, we call a user a bull or a bear depending on their same day sentiment. So the analogy here is we see someone declare themselves, let's say a Republican today, and then we see if they set their DVR to record Hannity or Maddow tomorrow. Okay, and so then, you know, here, for example, we look at whether people choose to follow bulls, and you can see people who declare themselves a bull at time zero are much more likely to follow bulls over the next 50 days than people who declare themselves bears. You know, there's about 5 times the difference. And then if you look at bearish investors, you get the opposite pattern. People who declare themselves bears are much more likely to follow other bears than people who declare themselves bulls. Now, we can look at this in a regression specification. Simply put, here we have an indicator for whether you follow a bull between the, you know, in a specific time period, and conditional on you declaring yourself a bull at time zero. Yeah, and we have 2 key controls here. One is an individual fixed effect absorbing kind of person level heterogeneity, and also a stock day fixed effect that absorbs news. So we really, even though it's a very simple specification, because of the structure of the data, we can really absorb a lot thanks to this stock day fixed effect. And if we look at the regression, essentially here is the coefficient on declaring yourself a bull at time zero, on new follows at time 1, or time 1, 2, and 3, or time 1, 2, 3, and 5. And you can see that basically we find effect sizes of about 40% of the mean. Yeah, so people who declare themselves a bull at time zero are much more likely to follow other bulls at time 1, on day 1, 2, 3, 4, 5, and further out. And if we conditional on at least some new follows in this window, you know, it's a 20%. The way to interpret this coefficient is a 20% increase in following bears relative to following bulls relative to bears. So 24% effect size. Now, so you know, to step back, we see a lot of people endogenously setting up their news feed in response to their own stated beliefs. Yeah, there's always a day symbol fixed effect. Now, which stocks have very bearish echo chambers? Basically, if you look at these are just stocks that have had very sustained bullish periods. Yeah, so stocks that have gone up a lot over time are the ones where we see the most intense bearish echo chambers. And then for bullish echo chambers, we see a very different pattern. It's pharma and it's essentially pharma stocks. So stocks with a very binary payoff structure. Pharma stocks in general are going to be stocks where small pharma, by the way, small pharma is basically going to be, is this drug going to work and be a home run, or is it going to be a failure? Binary outcomes, you see very strong bullish echo chambers, or the strongest bullish echo chamber as well. Okay, now we also look at news feeds and likes to see, you know, basically messages of different types and likes, and we basically get the same result as we did for follows. I'm gonna, in the interest of time, I'm gonna skip it. You know, people like more bearish messages if they themselves are bears. People see more bearish messages if they themselves are bears. Now let me get to, in the interest of time, let me get into kind of some heterogeneity and other things. But hopefully, you know, we've convinced you that there is at least a very strong pattern of endogenously choosing to follow, to see, and to like messages, people, and posts that accord with your priors. Okay, now first question: do only amateurs exhibit this selective exposure behavior? And the answer is, you know, well, maybe experience will reduce biases, and we see self-described financial sophistication in 3 categories, and we find that professionals are least likely to make selective exposure decisions, but they still do. Yeah. So if we look at it in a regression setting, you know, these are indicators for being interacting our follow regression with an indicator for being a novice, for being an intermediate quality experienced investor or professional investor. This is the baseline of 1.83%. This is for the next 5 days. This is reduced if you're a professional investor, but only by about 1/3. Yeah, so professional investors are still very much associated with this echo chamber behavior. They incur the same kind of errors that novices do, just only slightly less. Yeah. Okay. What about, how does the arrival of news affect selective exposure behavior? Well, we observe more selective exposure on extreme news days. So, you know, this is a parallel to the Candell and Pearson results showing that there's more trading volume around earnings announcements. What we see is we observe more selective exposure behavior, more self-selection by following on extreme news days, which is actually kind of tricky to interpret. So I would appreciate if someone has great ideas about this. But here, you know, we do the same follows regression, and we interact with dummies for if the return on a specific stock on the follow day is, on the sentiment declaration day is over 5%, on the day after that is over 5%, or the opposite, if it's under 5%, under -5, under -5, and then the same with 10. And you can see that these interaction terms are positive, yeah, in both positive, for both positive large returns and negative large returns, yeah. So it's just news, big returns days, which we're proxying for by, big news days, which we are proxying for by big returns, are accompanied with kind of a doubling down of echo chamber-like behavior. Which I mean, it's hard to explain because it's hard to explain echo chamber behavior in general. But you know, so this is just exacerbating this behavior. So now I have, according to Tony, do I have 7 minutes left? 10. Okay, great. So now I want to think about 7. Okay, yeah. I want to think about. Okay, so to summarize, we see echo chamber-like behavior in terms of structuring your newsfeed. So the endogenous choice of who you choose to see based on your own declarations is consistent with selective exposure, consistent with this echo chamber-like behavior, both in terms of who you follow, what messages you see, and which messages you like. And then we show that it is stronger for novice investors, but still present for professional investors, and it strengthens on days when returns are extreme, either positive or negative. Now let's think about this idea of information silos. So echo chambers actually might generate information silos. So what do we mean by this? Well, first of all, let's set up the baseline. So in the baseline, without echo chambers, the distribution of the original signals that are sent out would look similar to the distribution of the signals seen by each receiver, seen by the people who see the posts. Yeah. So let's imagine you have original signals, you know, one about a specific stock. So one is bullish, one is bearish, 2 more bullish, 2 more bearish. Yeah. And then, you know, they get sent out to the receivers. So this receiver sees 1 of each, this receiver sees 2 of each in different orders, and so on. Okay. Stylized example, of course. Now, in an echo chamber setting, what we should see is clustering of the same sentiment signals within receivers. If I'm a bear, I'm more likely to have followed the bearish senders, and so I'm more likely to see mostly bearish signals, mostly bullish signals if I'm a bull, and so on. Here, obviously stylized, so here people only see kind of what their prior was. But this idea of echo chambers leading to clustering of same sentiment signals shows you that that it could plausibly generate a wedge between the signals sent and the signals filtered through the network that people receive. And so first thing to do is to calculate as a baseline, what's the probability, if everything were kind of independent or random, what's the probability of receiving all the same signals conditional on the signals that were out there, the signals that were sent. And so for example, if you had like 4 bullish and 2 bearish signals and the receiver saw only 2 signals, then this probability is just 4 choose 2 plus 2 choose 2 divided by 6 choose 2, which would be 47%. And so then what we're going to do is we're going to compare this number with what the empirical frequency is. So, if we find that in this setting for this exact setup, we find the same signal 60% of the time, then this is suggestive of clustering and information silence. And we do this in a regression and we find it, but I'm just going to show you a graph of what we find. So here, this diagonal line is what you'd expect under, random assignment. Here is the probability that a user receives only messages with exactly the same sentiment, and the bars are the empirical frequency. Yeah. So we would expect in this bin of 5 to 10% that people would see messages all of the same sentiment, 7.5%, and yet we see it at 17%. Systematically, there is more same sentiment signals clustering within receivers than we would expect by chance. So which is very suggestive of information silence. Yeah, and so you can see that there's a difference. Now, let's think about how this might affect trading volume. So Cookson and Niesner have this paper, which I've mentioned, which relates sender disagreement to trading volume. So they relate the disagreement in the original signals to trading volume. That's the essence of one of the major points of the paper. Now, what we do is we take a further step from there, and we relate received disagreement and received uncertainty to trading volume, conditioning on whatever the sending disagreement is. So what we do is we say, is there an additional effect from this network structure that people endogenously set up for how they receive the information? Yeah. So what we call information silos, do they affect trading volume? And we will show you that it seems that they do. Yeah, it's an association, it's not a natural experiment, but it seems that they do. So let me just kind of show it to you in the setting that we have here. They have a numeric convention where they say, oh, let's categorize a bull as a +1 and a bear as a -1. So let's do that. And then, the sender disagreement is just the standard deviation of these. It would be like 1.09 in our setting. And so in a very kind of non-siloed sense, what we would have is if there's, half bearish and half bullish signals, then that would more or less be replicated among the receivers. So the distribution of the original signals would have a pretty similar distribution among the received signals in the receiver's news feed. So the network structure would not greatly distort the structure of the information received. If we have siloed information, then actually we would expect something different. We would expect received disagreement, so the standard deviation of the mean signal to be greater, and received uncertainty to be lower. So essentially, the disagreement, the difference between the means of the receiver should go up, and the within receiver standard deviation should go down, thanks to this endogenous clustering, thanks to the fact that you're choosing to receive information that fits your priors. And so, these are stylized examples, but we can calculate these numbers, these empirical numbers, and look at it in using our stock sorts data and relate this to trading volume. But what's the intuition? So I have about a minute left. So I'll just do this final section and then I conclude. But the intuition is, imagine the Wall Street Journal and the New York Times write different kind of takes on the same event. What this official is doing is great, what this official is doing is terrible. That's kind of the analogy to the sender disagreement, the original message disagreement. And then if the population, as in different groups of the population, they read only one of these two takes, then people's news feeds become more different to each other. So received disagreement goes up relative to sender disagreement, and they become more internally consistent. There's less received uncertainty. And so what are we going to do? We're going to look at if this affects trading. Yeah. So we're just going to see actual trading volume, on the US stock market in relation to these variables. So here's the table. Column 1 has sender disagreement, from Cookson and Meissner's JF. And you can see, that basically more sender disagreement leads to greater abnormal log volume. We have lots and lots of controls following their paper. And then we successively add received disagreement, received uncertainty, and we have them both. So column 4 is our preferred specification. Column 5 just has them without most of the controls. And you can see that they have independent and large effects. How large? So how to interpret these coefficients? Basically, these are normalized and standardized. So a 1 standard deviation increase in either sender disagreement or received disagreement. So these two here increase abnormal trading volume by about, on StockTwits, by the way, increase abnormal trading volume by about 4% of the mean. And increased standard deviation of receiver uncertainty reduces abnormal trading volume by about 1.5% of the mean. Yeah, as would be expected. This is intuitive, but these effects are pretty large. Now, I repeat, there's no natural experiment here, but these correlations are so we have day fixed effects, month stock fixed effects, message number fixed effects, controls for news, controls for Google search volume, for volatility, for preceding abnormal returns, cumulative, for the day before's abnormal log volume. So this is a real battery of controls. And so this suggests that this network structure, this echo chamber behavior in how you generate information that you see is having effect on trading behavior. So to conclude, we find pretty strong evidence, we feel, that bulls and bears choose to receive information that fits, that confirms their prior views, which is surprising given that people should have an incentive to choose information to receive all value relevant information. And finally, we show that the corresponding information siloing that this generates is strongly related to higher trading volume. I think I'm out of time, so thank you very much. And as I said, this is really, really an early stage paper, so any information, any comments would be greatly valued.